Welcome to Odds and Ends. I'm Dave Singh here with Rob Friesen. So we're here to get our bearings on the week ahead and see how we can use the data and StockOdds to help give us some trading edges. And we just finished up this big volatile week. We're poised for more macro themes in the week ahead. Tomorrow's the last trading days of February. We have a new month starting. We have Fed speak, earnings, and it seems like the market has four big eyes this week: invasion, inflation, indigestion, Fed speak, and insanity, right? The oil prices. So it's a big week ahead, and let's get Rob's take on all this. Good evening, Rockhouse. How's everything? And what do you see?
That was pretty creative there, the four eyes. I got to hand it to you. That's pretty good. So, yeah, it is very interesting. Very sad for many people affected by this. I mean, loss of life, humanitarian crisis, obviously. Just very, very sad to see. But we're traders, and we have to look at what is happening and respond with positioning ourselves in the areas that have the best proceeds. And as traders have done in the past, some people have made money off of different types of events that enabled them to be able to then donate money to the Red Cross, to certain organizations that can make a difference and help out. So that's good that we can be proactive like that too with what we can take out of the market. So let's try to equip everybody to do better and make a difference. So we are seeing, as of the moment here, the Dow Futures are down 595 points, or 1.75%. And that puts it at an inside day for the range that we had on Friday. So we're not back down to the lows. It did open down once the futures started trading today, and then it slid from that. It's had a couple little spikes with possible negotiations that may take place in Belarus or whatever. But, at this point, not much can be trusted because it's a very volatile situation, obviously, right? And the more embarrassed Putin gets, with how badly this operation runs, let's say, the more unstable, the outcome could be. So it's nothing that we can put a pin in it and say we know exactly what the outcome's going to be. We just don't. But we know these things, that the market had an incredible Thursday and Friday, so two days stacked on top of each other that were quite remarkable, and probably two of the best top 10 trading days in the last 10 years, by the magnitude of what we saw and the opportunities that were there. And it is counterintuitive, a lot of this stuff. So we try to communicate what we've learned from the markets over the last 20, 30 years. And I can say emphatically that the market factors in everything that it knows or can anticipate. So this was not a surprise visit by Russia into the Ukraine. It's been mounting for a long time. And you don't position troops all around the border, as generally as only a scare tactic. If you moving that type of hardware into and personnel into the vicinity, it was likely that there was going to be an outcome that meant at least going in to annex the East, maybe more. So the thing is that the market was factoring the likelihood of an event occurring, okay? And then when the event occurs, we gap down and we start to rally. Why? Well, because the market already factored in, and now is a massive, buying opportunity for those that have been unloading along the way or shorting and want to cover, or just, had a wish list of things they wanted to buy, and away they went, and they went shopping at the open and then all through the day. And so we had 2 days in a row that had substantial rallies in all the indices. So now, whether it's in Asia, whether it's in Europe and North America, the markets are pulling back from that rally. So the magnitude of that rally is suspect in the sense of how frail it can become after, because you're going to have people that went along for the ride that might want to take profit. People might have suspected the outcome was going to be better, and now they're going to be surprised if it's not. And so this pullback is kind of to be expected, I think, as well. Now, an inside day makes it a bit trickier than buying a deep discount and seeing it come out of the hole. Those markets, while they still can be hard to trade, you have a lot more information about signal to noise ratio, right? You can see clearly the activity in terms of higher highs and higher lows as you go through the day. When you're in an inside day, if this is how it wants to play out all day Monday, then it's going to be choppier and harder to distinguish a clear direction and a clear thing of what to do. So we're really recommending that you be more diversified tomorrow. This isn't the type of day like we had, on Thursday or Friday where you can just come in and say, I'll just buy some great stocks and maybe I'll hedge with the SPY if necessary. It's not that type of day, because you might have negative alpha, meaning that the stocks that you're in are just higher betas and higher volatility, and the hedge of the SPY won't offset it if it starts to slide. Where if you were long and short both, that would be more offsetting. But when you have those deep discount days like we had, then you can take that approach of even being one-sided if necessary, and just holding on to your hedge loosely if you need to. So it's different markets, it's different dynamics, but what we're saying here is go to StockOdds and get your odds on the groups and try to be more balanced. Like, make sure you don't have too much exposure to one group. And those groups could be the technology, they could be oils, they could be commodities in general, gold and other metals and stuff too. So okay, so Dow's down, the S&P's down 110 points or 2.52%. NASDAQ's down 382.5 or 2.7%. So that's taking it on the chin pretty hard. And the Russell is the worst at the moment, which also had a pretty good showing the last 2 days too. So it's down 61.4 or 3% at the moment. And it opened, when the futures opened, the Russell futures, they just opened and immediately dropped more severely than the others. And the volatility has risen back to over 30 now on the VIX. So when you have high volatility, you're going to have things swing both ways. If the volatility starts to drop as we open tomorrow and the market's starting to build, let's say, then you want to target, moving back to test, to first of all, to fill in the gap if we actually open with a gap. So to fill in the gap, that would be number one. Can we get a gap fill? And that gap fill puts us, pretty much right back to the close. So it's a good target. So keep that in mind. But you'll have your indicators will be, the VIX will be smoothly selling down That means volatility is coming out of the market. The people that control other people's money aren't buying puts as much. There's some confidence coming back in, that kind of thing. So that's how to position yourself for tomorrow. Tomorrow is the last trading day of the month. Why don't you talk about some seasonality that you see for the last trading day of the month, and we can compare that to the macro.
Yeah, so I just did a screen in StockOdds for the seasonality almanac, final trading day of the month. In the past few years, this is a kind of a risk-off day. A lot of funds deleverage and degross their risk on that final day. So it tends to be a down day just in general.
In and of itself,
yeah. Exactly. But particularly for the last day of February, we're seeing symbols like solar symbols in end phase, ARC fund type symbols. So some kind of risk on for longs, and for shorts, things like biotech ETFs, financials, and oils typically. But in terms of sectors that are going to outperform or underperform based on the odds, IWM is expected to underperform the spider, and that's in sync with what we're seeing right now in the futures. Also, financials, energy, and materials are the ones that are typically underperforming the spider. And the ones that are outperforming the spider typically are the QQQ, XLK, SMH, and ARCKK. So some of your higher beta tech stuff typically would outperform on that relative to the spider on the final day. So it's a little bit mixed, but in terms of oil, I mean, typically you would expect it to underperform relative to the spider, but we have this major macro storm, right? And with it up like 4 or 5% pre-market now, it seems a bit tricky. I mean, if it opens up 5%, is the premium built in and it can retrace, or do we just want to be long only on oil? So oil seems to be a trickier one. You're either going to really make it or break your day's P&L based on that. So how would you play oil for tomorrow?
Well, my long range assumption would be that we're going to be pushing back towards the 150 a barrel. So 147 and change is kind of where oil hit back in, I believe it was 2014. I could be wrong, but maybe I got my years off. But anyway, the last sort of super spike that we had of oil, and then from there it really dropped massively down. But I'm thinking that is definitely possible, and it's not just war related. It's because the futures are still in backwardation, and that puts an upside potentially on that for this next contract, as well as supply chain stuff. And we don't know, whether the OPEC countries will sort of step up to, help alleviate this problem. I mean, as oil is pricier, it does put more revenue into Russia's coffers, right? But at the same time, countries, haven't moved to completely sanction that either. So it's possible. I mean, I see that it wouldn't take much more, bad things to happen to create this super cycle. So that being said, because oil had such a massive rally over the last 6 months to 7 months or so, it's normal that there's some profit taking now that we're in the event. So that same rule that I mentioned at the beginning of the program is still true, and that is the market is factoring in. What was it factoring in? Supply chain problems, demand increasing with the reopening economy, the fact that, the environmental talks, really was no outcome that was, reducing the consumption of oil. It's like, we know we got to get all green and everything, but, we're not ready to do it yet. Nobody's, really stepping up. So you put all those things together, and I think you just have an environment where oil certainly could, have a correction, pull back a bit, and then get back on its way to continue up. Now, with the war going on, obviously you're not seeing a much of a correction. It's been down a couple of days, right? But I don't think that that's permanent. I think it's just a little bit of a blip just because of how much it had moved. And then the crude futures now, are up from where they were on Friday's close, right? So we have moved up, but we're not making any new high. So it'll have to get back up over the $100 a barrel firmly, and then continue to build. I see 112, 115 very possible just within the next few weeks, and possibly worst case scenario, it could go back to 147.
Yeah, that was back in 2008, July 2000.
Oh, is that when it was? Okay.
Yeah.
Okay.
147.
Okay. Yeah, I just remember the price got up there. Yeah, and then it fell from that high all the way down to something like 39, I think, if I remember correctly, like 39 something a barrel, or 37 even, I don't know.
Or minus 80, right?
Well, no, that was in 2020, right? So minus. I don't even think the minus shows on a chart, does it really?
No.
Yeah, nobody's equipped for those minuses on commodities. Imagine that all the commodities of the world were minus and then you could buy some. That would be amazing. Anyway, so this puts a macro opposition to the seasonality of that XLE being down on the last day of the month, right? As we stand right now, it's up from Friday's close, but it could still be down open to close. So if you're looking at it from a close to close perspective, it may fail. But if you're looking at it from an open to close, we may actually open high on XLE tomorrow and pull back all day. If, for example, there's progressive talks that mean that maybe there's some hope of, of ending this thing sooner than later, right? Okay.
Very good.
Now we need to look at all of the commodity space to see what is really being affected here. So currencies, the US dollar is up, right? So what does that benefit? And that would be less likely to roll over hard on you. When the dollar's up, it doesn't change direction that quickly. It's not as aggressive as something like, if you went long GLD and it decided to be a risk on day, they would probably sell the gold down pretty quickly, right? But the U.S. dollar won't be that impacted. Let's just see here. So we've got crude is up, Brent is up, West Texas is up, gasoline, heating oil, natural gas, gold is up. We're back to 1909 on that. Silver, but here's the thing: we have not beaten on any of these things that I've mentioned the high that was set a couple days ago. So that's still in place. Let's see, wheat's up, and wheat is like Russia's a big supplier of wheat, right? So wheat's up. What else are we seeing here?
Yeah, gold was up to like 1935 a couple days ago, and it's only 1909 right now.
Yeah. So I mean, it's up from Friday, right? So that's the thing that people are going to see is it's up from Friday, but you have to look at context. Where was it in this last week? What are the highs that were set and where we are? So I'm seeing a lot of inside day or inside the last 5 days. I'm not seeing like brand new highs across the board on any of these things that are sort of defensive, right? And we're not seeing new lows on the markets. So I think just treat it. I think come in tomorrow and treat it like that inside day. Try to be diversified in your longs and your shorts. Just monitor your exposure to technology. You don't want to be too one-sided. Your gold and silver and basic materials in general, you don't want to be too one-sided. I don't know what's the futures doing on treasuries and stuff here. What's going on there? Bonds. So we've got another thing with Powell speaking this week. We've got some we're waiting for some clarity on what may be happening for the March meeting and some guidance there. So there is some Fed banter, and people have said that the rally that we just had was related to the fact that with the war, the Fed would probably be less hawkish and more dovish. I don't think that statement is entirely true. I think the reason is that we still have a massive inflation problem, and it's only gotten worse with all the events that are going on. And they do have to deal with that. And I think the market rallied partly because of that expectation, but obviously partly because of what I said at the beginning of this podcast was the market had already factored in things related to the war, right? Mm-hmm. So I think it's two-pronged, and I think that the indication of that is the war is still going on, and we're pulling back on the futures, right? Mm-hmm. So should we not still be rallying if the argument was only about interest rates? We should still be rallying right now. We should be rallying into Monday. We should have a big up day on Monday. But I don't think that's the case. We're pulling back now, and the market is, so it's not all about interest rates. It's about the macros globally and about the Fed's posturing and what they're going to do. So we have to hold both concepts and we have to deal with them. And this week on Wednesday, Thursday, we do have some more Fed speak. So, we'll have to see what we can get out of that. So anyway, just remember, it's not just the last day of the month tomorrow. We then, from where things close, we have the turn of the month effect into the first day of the new month. So on your seasonality calendars, get orientated with the first day of March and what to expect there, because you'll need to take that into consideration for anything you might want to swing trade, or pairs that you might want to create, or just doing your basket trading going into Tuesday morning as well, right? Okay.
Very good.
Anything else?
No. Well, I think today that the term nuclear really spooked the market, getting his nuclear deterrent to high alert. I mean, Putin. I think that's what did it for today. Otherwise, I think we might have just continued rallying in with knowing the invasion is going on and there's possibilities of talks, and he's going to keep playing and manipulating positioning. But I think that keyword, nuclear deterrent on high alert, that kind of really spooked everyone today.
Well, yeah, I mean, there's going to be the propaganda playbook, going on all the time too, right? I mean, it's all everything's based on lies. It's just so much of this stuff. And, if you're going to be headline driven in your trading, it's going to be, kind of a crazy road to walk. So we have a better plan with StockOdds, and that is long and short trading. And you get to decide, that's where discretion can come in, is how much exposure you want to a particular sector or industry. And if you don't want one-sided exposure, then you can be long and short within the group. So that's the beautiful thing that we have. I mean, none of this sort of phases us in terms of what's going on in the world, really, but we can optimize our trading by doing some of the things that we mentioned here, which is like on Thursday and Friday, those were good days to, take a little bit more risk because of the deep discount, and get filled on some of these longs that you wanted, and then decide to hedge with either the diamonds or the SPY. And if I see if it's a really sort of aggressive risk on type of day, and I originally hedged with the SPY, I might even take a bit of that off and put some into the diamonds, because the diamonds, generally tend to not perform as well if they're going after things like the Qs and the Russell and stuff like that. Mm-hmm. So you get to decide how much exposure you want, or you can kind of strip it out almost altogether. If you are long and short, electrical utilities, or if you're long and short some REITs, or if you're long and short some money center banks, you are taking a bit of the market out, or a lot of the market out, and you're also taking some of the macro out. You're not going to be as impacted if you sort of get it wrong. I mean, it's going to be reducing the variance on your trading account tremendously. Okay?
All right. Good luck.
All right. Take care.